Question 26. Parker Inc. acquires 70% of Sawyer Company for $420,000. The remaining 30% of Sawyer's outstanding share continue to trade at a collective value of $174,000. On the acquisition date, Sawyer has the following accounts. Those are accounts that might have a different fair value from book value. One is land, the other one is buildings. And buildings have a 10-year remaining life. In addition, Sawyer holds a patent worth $140,000 that has a 5-year remaining life, but is not recorded on its financial record. At the end of the year, the two companies report the following balance. Okay, question 1, requirement A. Assume that the acquisition took place on January the 1st. What figures would appear in the consolidated income statement for this year? Okay, so in order to get the consolidated income statement, we know that there are some assets that have a different fair value than book value. So our first step is to calculate what is going to be the excess annual amortization expense. Okay, so which means that we can use this table first. Okay, so the adjustment amount well, current assets, they all have a fair value equals to the book value. Land is undervalued by 10,000. Buildings are undervalued by 30,000. And liabilities has the same book value as fair value. Okay, so we can focus on land and buildings, and which means that we need to look at their remaining life. Normally, we do not depreciate land. While for buildings, buildings have 10-year remaining life. Okay, let's see whether we missed anything. And there is a patent that it currently is not recorded. Well, it has a fair value of 140,000. So the adjustment amount will be 140,000. Remaining life is 5 years. Alright, so let's see what's the annual amortization. For the buildings, that will be 3,000 per year, while for the patent, that will be 28,000 per year. So in total, there are 31,000 excess annual amortization expense we need to consider when we calculate the consolidated income for this year. Okay, then let's move on to the income statement data. So we have Parker's and Sawyer's revenue and expense, and so next we need to input those adjustment amount. So the consolidated revenue equals to the revenue of Parker plus revenue of Sawyer, that's 1.5 million. And then the consolidated expense will be the two companies' book value of their expense and plus the 31,000 excess annual amortization expense. So total equals to 1,031,000. And the consolidated income will equal to the consolidated revenue minus the consolidated expense. It equals to 469,000. Okay, so that's the consolidated net income. Well, we can also calculate what is the reported net income by the two companies. So Parker has a reported net income of 300,000, while Sawyer is going to have 200,000 reported income. And next is to calculate how much will be allocated to non-controlling interests. So non-controlling interest have 30% of the subsidiary company. So which means that so net income to non-controlling interest would be 30% of the adjusted income. From the subsidiary company, it equals to 50,700, and then the net income to controlling interest would be the total consolidated income minus the net income that's allocated to non-controlling interest, and then we got $418,300 that will be allocated to the controlling interest. Okay, and then let's move on to next question. Next question is, assume that the acquisition took place on April the 1st, and so revenue and expense occurred uniformly throughout the year. What amount would appear in the consolidated income statement for the year? Okay, if that is the case, we're going to use their revenue and expense information, but we need to make some adjustment. So adjustment is that because the acquisition took place on April the 1st, which means that only the revenue expense that is earned or incurred after April the 1st will be considered their combined income. And that will be, so the fraction of a year after their acquisition will be 9/12. Okay, so that's the fraction of a year that they are together. And so which means that when we calculate the consolidated total, we need to times 9/12 and to show the fraction of a year that these two companies can be considered as one entity. Okay, so the consolidated total revenue now will be 1,350,000. And what we have done here is we add the two reported revenue together and then times 9/12. And then we are going to do the same thing for the expense. Add them together and plus the 31,000 excess annual amortization and times 9/12, and that equals to 923,250. Alright, so the consolidated income will be 426,750. Okay, so next is how much of the net income that can be allocated to non-controlling interest. And now it's going to be, if we have this 200,000, so that will be 20% or 30% of the adjusted net income times 9/12 equals to 38,025. So that's the net income to non-controlling interest. And then if that's the amount we allocated to non-controlling interest, then the net income to controlling interest will be the total consolidated net income minus the amount that is allocated to non-controlling interest. Then it equals to 388,725.